Thanks everyone for joining. Today we're blessed with some OGs in the space who have been around for years and years, and we're going to be talking about the banking crisis and how DeFi can shine. So I'm Sam, I lead growth at Liquity, and today we're joined by Michael, the CEO at Liquity. We're also joined by Meltem, crypto dickbud connoisseur and also crypto strategy officer at CoinShares. And we're also joined by DeFi Dad, who is obviously the educator that we all love and know, and also an investor, a partner at 4RC Investments. So before we begin, I guess, as the topic is the banking crisis, I wanted to give a quick.
Oh, Sam, you cut out for me. Did Sam cut out for anyone else?
He did. Yeah.
Yes. Yeah. I
Sam,
think we need to take over.
yeah. Wait, Michael, why don't we
So
start? Can you tell
yeah,
everyone about Liquity? Because I feel like it's been a while since we've talked about stable coins. Full disclosure, I am a Liquity investor and an avid user of Liquity, but I think it'd be great for everyone to just get an understanding, like what the heck is Liquity even? What is LUSD? Maybe just give us a quick primer.
sure. Yeah, I mean, Liquidity is an interest-free borrowing protocol, which allows you to take out a loan against your ETH. And by doing that, depositing ETH and taking out the loan, you do that in the Liquidity's own stablecoin, LUSD. So it's similar to Maker, but it has key differences. And I think that will be also a topic today. What makes Liquidity really special is that it's fully decentralized, a full stack decentralization, meaning this is a immutable protocol which only takes the most sound collateral, Ethereum. And so the stablecoin is also very, very special because it's almost the only major stablecoin that is fully decentralized, that has no ties to centralized parties. And I think that makes it shine in these times of banking crisis.
Yeah, and maybe I'll just add a little bit, Michael, just since I have been using Liquity, just in and DeFi Dad, maybe you can articulate on this since you're the educator here. What I think is really interesting about Liquity is if you have a crypto and you want to utilize it to get cash or stable coins that you can use in different ways throughout DeFi applications, or even if you want to get fiat in your bank account, since I think most of us are still paying our bills and our day-to-day expenses in dollars in a bank account. Liquity has been a great tool, at least for me personally. If I want to use Aave or Maker or other protocols to borrow, typically there is an ongoing a fee. There's an ongoing interest rate that I pay. And in many instances, it's variable, so it can fluctuate quite a bit over time. What's really cool about Liquity, if I have ETH, the only collateral Liquity is taking today is ETH. But if I have ETH, I can go to Liquity. I pay a 50 basis point loan origination fee, but there is no ongoing interest rate. It's just that 50 basis point origination fee. And then there is sort of a collateral requirement that you need to meet. So you mint a stable coin called LUSD, that's Liquidity's native stable coin. And as long as the peg of LUSD is above a certain threshold, you are fine. Once LUSD drops below the $1 threshold, then liquidations do begin. So I just always like to keep my collateral ratio nice and high. Usually aim for 150%, but in times of volatility, I keep it a little higher. Very similar to how it works in other protocols that are crypto collateralized in general, and just in any collateralized loan. But Liquidity has been really interesting for me because we're so accustomed to paying an ongoing interest rate. So the ability to fluctuating, interest rates. So the ability to originate a loan for a very low one-time fee makes it really easy. And then also when you're doing your taxes, for those of us who live in jurisdictions with complicated taxes like the US, for me personally, it's been great to not necessarily have to sell crypto. And then that one-time loan origination fee is really easy to account for as well, as opposed to trying to track sort of that ongoing fluctuating interest rate you're paying to borrow. So for me personally, I think LUSD has been a really great tool. So that's just a brief summary of why I think it's interesting personally. And then one thing I think we really want to talk about today is just some of the key differences in stablecoin construction and how it impacts risk in particular, just given the recent banking crisis, but also risk from a sovereign perspective. I think we see a lot of stablecoin projects now starting to hold treasuries or other sovereign assets. And I think just, thinking through some of the risks will be really interesting. That's something I'm excited to explore. But hopefully that's a helpful anecdote to people who are listening. Maybe you identified with some of those use cases of LUSD. And if you've experimented with it yourself, I think the interface is really simple. The process of, originating a loan is pretty simple. So just, a lot of things in DeFi are very complex. There's a lot of buttons. There's a lot of things to track and look at. Liquity is really simple in my view, and that simplicity in design, I think, is one of its really strong features, because the surface area of complexity in DeFi can get overwhelming really quickly. I'm not, the brightest bear in the circus, but if I can figure it out, I feel like many other people can figure it out. So for me, I've enjoyed using Liquity. I know others have enjoyed using Liquity, and I know particularly around tax time in the US, LUSD has been fairly popular with folks as a great way to sort of take advantage of the opportunity to stay fundamentally long ETH, get some cash that you need, and to use some of your crypto assets in a productive way. This is very similar to the way that people who own a lot of stock can use that stock as collateral, or people who own a lot of assets just generally can use the traditional financial system to not have to sell these assets and not incur capital gains taxes or other taxes, while still being able to utilize the value of that collateral in a productive way, whether that's paying bills, whether that's reinvesting that capital. So I'll stop there. That is not investment advice, by the way. Nothing I say is advice. I'm just sharing an anecdote of how I find LUSD useful.
You guys should clip what Meltem just said and just use that as an ad. That was great. And actually, Meltem, that mirrors my experience too. So if you talk to like a real OG in the crypto space like Meltem, because I'm like a newbie still compared to how long she's been in crypto. She lived during a time where you really did think to spend Bitcoin or eventually Ether, and it's protocols like Liquity that are definitely like they set a standard in DeFi where they have they've designed a protocol that is truly meant to be unstoppable or censorship resistant. And that's part of the reason the only collateral at this time is Ether. That could change in the future, maybe something like a staked form of ETH. And the ability to mint a stable coin and not trigger taxable events depending on what part of the world you live in. But for me, living in the US, anytime I breathe, I create a taxable event with crypto, especially when I sell anything. And so Liquity's been, for me, a lifesaver, especially during taxes. Nobody wants to sell their Ether when, the price was down, whatever it was, 80 something %. And protocols like Liquity, again, allow me to be able to lever up against that and borrow against it. So anyways, just thanks for having me, guys. And guys, how should we kick off here? I think everybody sort of knows now. We know Liquity, we know Meltem, we know me. Do you guys want to level set with just a bit about the banking crisis and then what we're going to talk about?
I think that would be a good starting point, because also the banking crisis triggered a lot of things that I started to thinking about our banking system, about the different types of dollars that are out there. It's almost a bit intimidating that I didn't do that before, but everything was working. And now that it's not working, I think these things just become more important. And I Meltem, by the way, I listened to your great podcast with Caitlin Long. I think maybe just summarizing the gist of it, because there you talked about an hour about the banking crisis and what's going on, could set a bit the context why we are here, and maybe also why we chose the title Where DeFi Can Shine and where it can provide alternatives and sometimes even better products.
Yeah, and let's maybe level set really quickly. I think everyone is probably tired of hearing about the banking crisis. And I'm not a banking expert per se, although I did have the misfortune of spending a lot of time working on implementing banking liquidity requirements after the '08 financial crisis. I also had the misfortune of graduating college in '09, which was just a lovely time to be working in finance. I had the joy my senior year of having my offer rescinded, trying to figure out what to do, and ended up, dealing with the fallout, the implementation of Dodd-Frank, the implementation of Basel III, which was basically, there's this huge banking crisis in '08, '09, because a bunch of banks held these assets called mortgage-backed securities, or MBSs, on their balance sheets. And when those, kind of went underwater, imploded, a bunch of banks were left with garbage collateral on their balance sheets that suddenly became worthless. And the key idea here is asset liability mismatch and duration mismatch. I'll just break that down really quickly. Asset liability mismatch is what happens when you, on your balance sheet, hold assets that do not match your liabilities. What's really interesting is when you take a deposit as a financial institution, as a DeFi protocol, that deposit actually becomes a liability because you owe money to someone, and the cash or the securities or whatever is deposited, the underlying asset itself becomes an asset on the asset side of the ledger. So on the left side, if you remember your little T chart from accounting, and even though accounting is very boring, I highly recommend basic understanding of the accounting T chart. You have assets on the left side, liabilities plus equity on the right side. Very simplistic model. I take in deposits. I now have a liability to deposit holders to repay them. And I have assets in the form of the underlying cash or securities or assets that are deposited on the asset side of the ledger. Now, what we have to do is keep the two sides of the ledger equal, right? That's the whole reason it's called a ledger. We balance the ledger by making sure left side equals right side. Now, what starts to happen when you have a liability on one side that is fixed, but you have assets on the right side that fluctuate in value and can fluctuate a lot, right? By the way, this is a huge problem with crypto companies as well, particularly crypto exchanges. They may have assets that are very volatile and fluctuating dramatically in value on the left side, on the asset side of their balance sheet, but they may have a lot of liabilities that are fixed. The other issue, so that hopefully helps explain the asset liability mismatch, and we can talk a little bit about how that's different in DeFi. And then the other issue we get into is duration mismatch. And again, very quick summary. Duration is a finance term, as I like to call it. Duration basically means how long you hold the asset, or what the life cycle of the asset is. A lot of assets that are used in finance are short duration, like overnights, which are basically overnight deposit at banks. You have short-term treasuries, like the one-year treasury that's very popular. That's typically used as a risk-free rate in finance because it represents the lowest risk sort of asset you can hold. Cash, right, is basically a zero duration asset. It's highly liquid. It can be deposited, redeemed at any time. And then you have much longer duration assets. A mortgage has a lifespan of 15 to 30 years. So a lot of these mortgages that are getting packaged up are very long duration assets. Venture capital, for example, another one that's relevant in the SVB case, very long-term asset, an investment in a startup, that's anywhere from a 5 to 15 plus year asset. And so duration is very important as well. Where we start to get into trouble is deposits at a bank, right, are short-term assets. If I deposit $100 at the bank today, I can go this afternoon, tomorrow, anytime I want to be able to withdraw that $100. So the liability that I have to my customers as a bank is instant liquidity. It's short duration liability. But the assets I have on my balance sheet, right, could be very long duration. I could have taken some of that cash my investors gave me and bought a bunch of long dated treasuries. This is what SVB did. They bought a bunch of long dated treasuries with their cash that were delivering, 1.5 to 1.8% interest, which in a zero interest rate environment was attractive. At the current interest rate environment, where the 1-year treasury is pricing at 4.85% and inflation is, officially 6%, unofficially probably in the double digits, that is no longer really a viable proposition. You have a duration mismatch there because you have all these long-term assets that are underwater and you have this short-term liability of people wanting to take their cash out. So duration mismatch is the second important one. And again, DeFi is really interesting because we're able to eliminate some of this duration mismatch. And again, I think one of the fundamental premises of the Liquity design here is this ability to create and redeem instantaneously and not introducing this duration mismatch into the underlying design. So what happened? Why is this banking crisis happening? Number one, asset liability mismatch. Number two, duration mismatch. And then number three, the really big one, is a crisis of confidence. When people lose confidence in this age where everything is digital, in the age of neobanking, digital money isn't just crypto. Digital money has really accelerated and proliferated throughout our financial system through a bunch of the innovation that's come from fintech and also innovation that's been introduced into our underlying payment systems around the world. And so when money is largely digital, when money can move really quickly, when you no longer need to go to the bank to get your deposits out, but you can call capital via API with the click of a button, it suddenly makes capital hyperfluid and hypermobile, particularly bank deposits, in a way it hasn't been in the past. While on the flip side, those assets and the liability is hyperliquid because people can redeem and claim their cash instantly at the push of a button. But the assets you're buying and the assets you're holding on your balance sheet to back those deposits are not hyperliquid. They are not API driven. A lot of that investing activity, particularly in some of the more illiquid or more esoteric assets that people hold on their balance sheets, they're not really liquid. They're not really API driven. They're not traded 24/7, 365. And so it just starts to create a really interesting environment where you have this, what I call the big hot ball of money that's moving around at a really high pace, really fast by people, clicking buttons on the internet or even on their smartphones. And at the same time, you're interacting with the other side of the equation, which is still very much mired in the legacy system, moves much slower. And so those things taken together, that conflation has created this tremendous crisis of confidence. And then there's the last factor, which is speculation. And I think some of the Liquity team is from Germany. We're seeing this now. There is a lot of shorting of bank stock out there, which again, that bank stock is on the right side of the ledger. It's captured in the equity value. When the equity value of your business starts to decrease really rapidly, right, you start to run into problems. It's difficult to sort of manage your balance sheet. It's difficult to manage open market operations, which could be used to bolster your balance sheet and get more assets on the balance sheet by maybe selling some shares. So this speculation and like the shitcoinization of everything, if you will, meaning, stocks are really volatile. Equities are really volatile right now. That also starts to create challenges. And in Germany, actually, I'll just add an interesting anecdote that starts to allude to some of this like unstoppable finance captured by DeFi. In Germany, actually, the regulator implemented some rules post-financial crisis that made it impossible, right, for investors to short bank stock. And this actually became a huge issue in the case of Wirecard. There's a great documentary on Netflix about Wirecard, one of the most prolific frauds of the 2020s. It was a German fintech, basically made up all of their audited financials, made up their revenues, completely made it up, went public, reached a $29 billion market cap, right, publicly traded, and BaFin, the German regulator, actually for a long period banned shorting of Wirecard stock by these whistleblower firms. You might know Citron Research and others, or Hindenburg Research, who are typically like these short sellers, research-driven short sellers. But the German regulator BaFin actually, said, hey, you can't short this stock, made it illegal to short the stock. And so this is now being discussed in the U.S. It's, there's a proposal, I believe, in Congress to ban shorting of financial stocks, of banking stocks, which again is a sign to me, of the decline of the health of the banking sector. If you need to artificially manipulate the market and limit free market operations, in order to bolster confidence and stability in your banking sector, it probably prompts some examination, right, of what's actually going on. So I'll stop there. I'm sorry I talked for a long time. Hopefully that was informative, but if there are just some key terms to keep in mind: asset liability mismatch, duration mismatch, crisis of confidence, and then just rules around speculation and regulatory shifts. And again, we've seen this before. We've seen this repeated throughout history. And again, if the German example is any example, the end result is not necessarily so productive. And it does beg the question, in what we claim to be a free market, which I would argue the US is not a free market. In my view, crypto is really the only free market in the world today. And that's being changed rapidly as well. Just prompts a lot of questions about long-term stability. And like, as someone who owns on-chain digital financial capital, what can you do to just think about the risks you're exposed to and build a diversified portfolio, not just in the context of the assets you hold, but also the underlying risks you're exposed to? By no means am I saying throw all your capital into crypto or DeFi, but I think as a diversifier and an anecdote around against government incompetence and chaos, not such a bad idea. So I'll stop there.
Cool, thanks, Meltem. That was a mouthful. And I also would like to add a personal anecdote. I mean, I'm not so deeply in the banking sector, but what I really learned is how fragile the system has become. Kind of the banking system and regulation doesn't seem to be really fitted for today's world. And you mentioned that. We're living in a meme economy, in a GameStop era. So where with social media and mass movement, if you have some bored teenagers in a basement, if they start a movement, they can take down almost any bank right now by just withdrawing liquidity, them having an asset liability mismatch. And, that also started the thinking on my side, really just from a practical standpoint of view from our treasury. Okay, we have some dollars, and where should we put those? What happens if a bank goes bust? We have the dollars in a Swiss bank. How is that related? How does the dollar banking system works? Can I move the dollars or not? And then you said, hey, DeFi has great alternatives. You have these stable coins. But then again, DeFi is great, but then how are these ties to the existing world? How useful is a stable coin that is tied to these banks? And we've seen that with USDC. So suddenly, okay, I have a stable coin, but okay, it might depeg because it's tied to this bank. And that started to be, for me, really a learning journey to understand, okay, not every dollar is created equal. They are different. They have different risk properties. We just take it for granted. Every dollar you can exchange it for a dollar, but actually these are different dollars. There's a commercial bank dollar, there is a cash dollar, and they have different properties. And at the end, I was really thinking, okay, right now, for example, for us, the USD rails to exchanges in the US, we can't move the money, really. So it's great to have USDC. We're still able to move USDC. Luckily, Swiss banks can handle USDC. But even, with USDC, if now the government not only says, hey, you're not allowed to shorting, you're not allowed to withdraw your money because of bank runs, then we can't move that either. And then, I really started to realize that the nice properties of LUSD. And without shitting it too much, for us, it was really a strategy to diversify into a LUSD, because the realization that not every stable coin is the same, it hardened kind of the belief how a sound and resilient dollar the LUSD is, just from a risk perspective. Because if I hold the LUSD on my treasury, I don't have the counterparty risk. So I don't need to care of the bank if the withdrawals are stopped. I can move it every time. It's backed, it's redeemable, and it's transparent. I see the ETH is there. I'm not sure about, my bank deposits. Are they lent out long term? Are they still there? I don't know that. Can I move the dollars whenever I want, or can somebody stop it? Is it really unstoppable? And what is the jurisdictional impact on it? Is it borderless? And looking around and seeing at the alternatives, I was really astonished and also a bit proud to see how LUSD really differentiates from everything else that is out there. And it also sparked for me then a bit the discussion where we realize that how tightly interrelated DeFi is still with centralized and TradFi players. And I think that's something really we need to be more aware of, that we build more systems that are in parallel or not so dependent on the existing system. And I stopped there. I just wanted, to really show that people should think about these things also in practical terms. If you have now this banking crisis, what does it mean for your dollars? How do you move them? Where are they? What kind of risks are tied to your dollar? Is it better to have them in a small bank or in a large bank? It's actually not the same dollar. And you can see that you don't get the same interest rate on these dollars if you deposit them. But it's really hidden, and probably most people are not aware of. And I think that was the fascinating thing for me to see, hey, with DeFi, if done in a proper way and taking all the benefits of DeFi, you really get nice alternatives, being it on the stablecoin side, on exchanges, and so on. But just quickly wanted to share what kind of this banking crisis also led kind of to rethink how we do treasury on our side.
I'll just add that what I've been trying to do recently, as everyone's trying to assess where this banking crisis will take us, I repeatedly return to just really simple rules or guidelines, principles for myself to follow. And when I look at what's going on in that banking crisis, I think, will I be able to find some edge here that will allow me to outthink, outsmart, outperform the majority of the world, or especially those who are in the know in surrounding the banking crisis? And the answer for me is hell no. No, I will not be able to. I just don't have access to that sort of information. That's not my expertise. I'm a DeFi expert. I live in the world of crypto, specifically, on-chain, finance related applications. And so I'm gonna stick to my lane. And so, what I try to do is stay informed through folks like Meltem, who I think are really good at bridging the crypto space to traditional finance, because of course I do want to stay updated and informed, because so much of crypto is still correlated, over the long term to what's in traditional finance. And so this is where I start to double down on what do I know on chain that is unstoppable DeFi. And obviously one of the best examples here is what's offered through Liquity. And we'll talk about this shortly, but I start to think about what could truly be less impacted, or what's going to be the least impacted by the forces that be outside of the crypto space. And so, whether that's holding something like LUSD, being able to, provide liquidity with that, or thinking about where will the increase or the uptick of activity, economic activity in DeFi be if there's this crisis going on outside of the space? What are the sorts of things that people are going to be doing even during some sort of crazy, global financial crisis? And like I said, I think there's a number of things here we'll be able to point out, including the likes of using something like Liquity.
But I think that's a really interesting take. What's going to hold if kind of the banks crumble, or we just see some cracks? I mean, and it's a really important question, and you mentioned it. There aren't many options, and I think it should be much more clear what still will work as design. And one thing is ETH staking, very sound. You have DEXs, Uniswap, and Curve. They will be there. You can use it. Even if the SEC comes in and deems everything a security. Stable coins, we have LUSD, we have RAI, but not many other alternatives, and maybe there is borrowing. But looking at that, there aren't so many alternatives, and that's sometimes for me quite shocking, that we see, hey, where are we running in DeFi space? Isn't that the whole point of creating these alternatives instead of baking us into the existing system? So I would be really eager also to hear your point on that, Meltem. What you think, kind of, which part of DeFi can withstand that? Or do you see that totally different? Will it go down hand in hand if it crumbles?
Yeah, so I'm of two minds on this, and this isn't maybe an answer, answering a question with another question. So I've been in this industry or in the broader crypto space for 8 years professionally now, which when Sam introduced us, basically I'm ancient in crypto terms, which is lovely. I feel ancient some days. What I think is interesting, so when I started in crypto, it was Bitcoin. It was the Bitcoin industry. This concept of just crypto more broadly didn't really exist. And the idea in the early days of Bitcoin was to build a financial system native to the internet that operated outside of the confines of the traditional financial system. I think we have seen sort of a divergence in the world of crypto with the introduction of Ethereum and smart contracts, tokens, and then just the proliferation of L1s, L2s, DeFi, NFTFi now, the financialization of Web3 and beyond. There's just this absolute explosion, right, of different verticals in crypto. And more importantly, I think as this industry has grown, its integration into the traditional financial system has also been accelerated. If you'll recall, several years ago, the big narrative in the industry was institutional adoption, quote unquote. The institutions are coming, if you recall. But I think we have to recognize that this institutional adoption sometimes is a bit antithetical to that original vision of building these free markets, uncensorable, unstoppable financial tooling and infrastructure, because at its core, some of the underlying principles of what we're doing are not 100% compatible with the existing architecture, structure, rules, regulations of the traditional financial system. And so what I see now is an interesting divergence, and it's one I struggle with sometimes ideologically, but also professionally, because in my business at CoinShares, we build regulated financial products. We are a publicly listed company. We are very much operating within the confines of this traditional structure. But at the same time, we are excited by the promise of this decentralized, global, open, permissionless financial system. So there is this interesting ideological tension. But this divergence now is very much, being highlighted. If we look at the direction some projects have gone, such as USDC, Maker, and others in the stablecoin space, they have very much oriented more towards, being backed by treasuries, working with financial institutions like BlackRock and others to help custody some of the collateral they hold that backs their stablecoin. And while that, I think, makes sense from an institutional adoption perspective, and perhaps adding this quote unquote institutional credibility, at the same time, I think it also starts to potentially reduce some of the diversifying effects and this antidote to government incompetence, as I call it, effect of crypto, where we are actually also adding an exposure to some of these fundamental structural risks and structural challenges that we see in the dollar denominated debt, treasuries, etc. And so the view I've taken, and here's how I reconcile that, I guess, ideological divergence or these two different goals, is I think the two are very much complements. So I'm not of the belief that the US dollar is going anywhere in the short to medium term. I think, the US dollar is still the de facto currency of the world. I think the US dollar is the most liquid market in the world. And I think that there is a fundamental role for US dollars in the system as we know it. I also don't think systems change overnight. The arc of time is very long. And so this journey we're on is a multi-decade journey. I've been on it for almost a decade now, and I'm sure it will take many more. And I don't think we want the system to change too rapidly, because the amount of chaos it would cause, right? The amount of instability it would cause is quite significant. So I think that the position I've sort of taken is these things are complementary. There are products and services in the DeFi space and the broader crypto space that very much benefit from institutional credibility and deep integration with the traditional financial system. But there is also a role for, and fundamental importance to, products and services that don't have this dependence on the traditional financial system. And so you kind of have to view the two in tandem. And again, when I think about portfolio allocation and risk management, I think one dimension to include when you're looking at how you manage your portfolio, or if you're allocating assets professionally, or managing a treasury, or managing, your balance sheet capital, you definitely want to have assets that have institutional backing and institutional credibility. But I also think you want to have risk diversification and include a slice that perhaps isn't subject to some of the same market forces. I think this is one of my fundamental reasons for holding Bitcoin and minting and holding LUSD, is that, reduced dependence on the traditional financial system, reduced dependence on, institutional credibility, which, we're living in a world where our governments are no longer accountable to their constituents. And by large part, at least to me as an outsider looking in, it seems that our policymakers are just as confused as the rest of us are. It certainly seems that way. I don't know who's at the wheel. And so I think, again, just looking at that ideological difference and just understanding there is a role for both to play. I don't think we need to malign, the dollar or the existing sort of financial system, but it does have shortcomings. And there's this beautiful antidote. There's this beautiful other option that we haven't had before. And that's things like LUSD and other products in the DeFi space that do not rely on this institutional credibility, and operate purely off smart contracts that are, fully unstoppable. So this dichotomy, I think, is an interesting one. I think this tension is an interesting one, but I'm hopeful that over time we can, move to a place where it isn't so black or white, like banks are bad, down with the banks, but more of a world where it's, hey, banks serve a purpose. It's a very specific purpose. And as you're thinking about your exposure to risk, there is a very real risk factor here. And here are some of the different ways that you can mitigate that risk factor, or at least just plan around it. So I'll stop there. But I do think there is that dichotomy. I do think the view in this space is often very A or B. And I think instead of saying, banks or DeFi, it's banks and DeFi. That's probably, an interesting position to take. But I do think that is the narrative we benefit from most. And I also think logically that makes the most sense, just given these things take time. Like, I know we live in the age of Pepe and number go up immediately, but I don't think that worldview is necessarily so realistic. If we want these things to have endurance, if we want these things to have credibility is something that is earned over time. And so I think the longer we have protocols that function in a wide variety of macro environments, in a wide variety of volatility environments, and continue to perform as written, over a long period of time through those various market environments, the more that just bolsters the credibility of these products and services and assets. And I think the closer that gets us to this world where we have A and B and potentially, a whole host of other options.
That was fantastic. I hope my mic is fine now. That was great, Meltem. I think, that also raises another question. So you mentioned how, you should always think about these things as A or B rather than extremities, which we as humans tend to always do.
A and B, Sam, no or, it's and.
A and B, my bad. A and B, sorry.
Thank you.
But I was also, DeFi Dad, maybe you can chime in here. So, how would you tell the average Joe who's starting in crypto, how would you tell them to best hedge against the banking crisis risk that's currently posing the traditional system? So, obviously unstoppable protocols like Liquity are great, but what would be your kind of recommendation to the average Joe?
Yeah, I think I think one thing that newcomers have to level set with is there's a problem with attitudes around folks that are new to the crypto space. Those who come in, hyper curious to learn, knowing that it's going to take them time to find their footing, to learn, and to ultimately like figure out their own strategy. Those people do really well. The people who come in, with like a sense of entitlement, which I think describes a pretty large majority of users that come into the space, I'll say from the United States living here, there is a problem that goes beyond this discussion. I mean, we live in a society in the United States now where basically a lot of people, think that they just deserve to be rich and that they deserve to make X amount of money, and they see someone on TikTok making a bunch of money off a crypto dick butt, and they say, "Oh, okay, well, I can do that." And then when they get burned shortly after, they don't take accountability for their own decisions. So the most important thing for newcomers is if you don't have the grit to survive in this space for more than a year's time, and to again really like do your own research, not just like proclaim that you do your own research, but actually spend meaningful amounts of time learning about the spectrum of DeFi products and what is actually decentralized and censorship resistant or unstoppable and what is not. A lot of what is DeFi doesn't deserve to have the decentralized in front of it. And we'll get there. Part of it is because some of the infrastructure within DeFi, was lacking over the years, and we saw this explosion of growth starting in like 2020. And, for better or worse, lots of new products were created. But now that we've been through this bear market, you're sort of left with more of the true believers, the folks who like really see the impact of building in DeFi. So then to answer more specifically, what sorts of like DeFi you might start to look at? I mean, I don't want to stray from the simplest answer, which has always been to hold something like Ether or Bitcoin. I still think that is incredibly powerful, because if you hold that in a self-custody wallet, that's something that, let's assume that you don't write down your seed phrase and like, put it in an envelope that says seed phrase and put it in your sock drawer, like someplace that someone would easily find this. Let's assume that you really, take measures to ensure that no one can ever get access to your seed phrase. Like that's so powerful. And that's something that obviously if you're in a developing country and you have access to the internet, it is more impactful to you than some trust fund kid who, was buying Bitcoin on Silk Road and got rich and, really doesn't have any sort of like respect for.
If
Oh yeah, go ahead, Meltem.
If I can,
Please.
Dad, I'll just add a very real anecdote. I'm from Turkey. My family lives in Turkey. Turkey is experiencing an insane level of inflation. My family members, some of my cousins, used to only be able to hold lira and dollars. Both the lira and the dollar are rapidly, inflating. And now they have this third asset that they own. It's Bitcoin. Now, Bitcoin itself is also volatile, but the ability for them to hold Bitcoin in a self-custody wallet in a way that cannot be seized is very important. For my younger family members, that asset is Bitcoin. For my older family members, that asset was and continues to be gold, right? When my grandmother passed away, right, she had like gold hidden in different places all over the house. Still, when we have family events, when a child is born, when someone gets married, what you give people is these 1 gram gold coins or larger gold bangles. Like gold was still very much sort of that uncensorable wealth preserving asset that all families had and continue to have. Like I have these little gold coins I've accumulated throughout my life, which is so funny because we would never think of that in the States. That's not a tradition here, but in these countries it very much is. But for my younger family members, that asset is Bitcoin. And again, it's not 100% of their net worth. They don't hold all of their money in Bitcoin, but just the ability to have this alternative that doesn't need to be held in a bank account, that's not subject to capital controls, that doesn't have the risk of government seizure, this like new digital version of gold, which is such a tired trope, but I do think is quite effective here, is it is really like monumental for them. And so I'll just say that anecdote is, we talk about it a lot, but people are doing that is happening, and it does make a lot of sense. So just to add, very real life thing.
Oh yeah, that really brings it into perspective. So we've talked about the simplest use case here then, which is we're simply holding Bitcoin or Ether. We're okay with the price volatility, which is really like one of the major criticisms that newcomers especially will share, that okay, well, this thing has gone up a lot and it's gone down a lot, and like, how do I know I'm getting in at the right time? So let's just assume that you're okay with that price volatility. Going back to something I mentioned earlier, thinking about what parts of DeFi are going to see increased activity based on what we've observed over the last year, because DeFi is still relatively new. So it's not like 2022 was an easy year for everyone. It wasn't like it was obvious that we would continue to see such, enormous volume get traded on automated market makers, and, that there would be so much ETH staked ultimately by the end of that year. So a few of these places, no doubt, stablecoin liquidity is in my opinion a real opportunity. Whether I am a liquidity provider holding something like LUSD plus let's just use USDC or DAI, again, even though there are shortcomings to both of those with the exposure they have to some traditional entities. But let's say I'm a liquidity provider. Now, when we see volume spike on trading days, I'm going to benefit from that. And the best thing about stablecoin LPs is that unless the stablecoin depegs, of course, which truly has been, like that nightmare has been realized over the last year. We've just, thankfully, USDC survived and DAI did survive. Most days, though, in DeFi, it's been a pretty awesome sort of strategy. Another simple one is just bridges. And I'm going to assume that anyone who's looking into these strategies is well aware that there's a tremendous amount of risk when it comes to smart contract bugs. So bridges have been a big target for hackers, but all things, understood there, I think that bridges to something like an Ethereum L2, like Optimism, Arbitrum in the near future here, I think more liquidity will be there for something like a ZK Sync era, or going between the different EVM compatible L1s. That's been a great sort of yield strategy. And again, it allows us to just sit in something like an LUSD or Ether. The nice thing is I can deposit, in most cases, a single asset. And then I think actually, one thing I left out, I guess, on the simple holding strategy, and this is specific to Ether, because of the fact that we have EIP 1559. And for anyone who listens to this, if you aren't familiar with what's referred to as the ETH burn, you really want to look that up. EIP 1559. What happens is, when we transact, there's a base fee that gets burned. And so every time you transact on the Ethereum network, or even if you're on like an Ethereum L2, you're paying a small bit of Ether to transact. So the more competition or the more activity, on most days, the higher the fees are going to be. So again, this cannot be used as a hard and fast, like black and white sort of rule. But most days you could consider the fact that if the fees on Ethereum L1 or even L2s is higher, it's indicative of increased demand to transact, which over the long term, if that is sustained, we can consider that to be, and this is assuming that Ethereum, and other chains continue to scale and figure out better ways to handle that demand. Like, we don't want high fees over the long term, but sustained fees that are being paid is, I think, proof of product market fit, that people are wanting to transact so badly that they're ultimately willing to pay higher and higher fees. And a long time ago, that was something that would happen, but it was not accounted for, I would say priced back into Ether. But now that there's a burn, if you go to ultrasound.money, I mean, it's just absurd. Like, depending on the time frame you look at, if you look at since the merge, Ether is on pace to be deflationary on an annual basis. So it's burning so much Ether that the inflation is actually being outpaced by the amount of ETH that's burned. And so again, like, it's a very passive sort of thing that we benefit from by staking Ether or holding Ether and sitting in that, while all of this increased DeFi activity is on chain. When people are using Liquity to mint LUSD and using LUSD to pay for things. The last thing I would definitely encourage folks to just learn more about is there's been this increased activity around perpetuals trading. And what's really interesting about that is, and Meltem, I'm curious if you think about it this way too, but I feel like it's just a return to the original killer use case of crypto, that, no matter what stories we can tell and what future we can believe in, that, we can have this more democratized, permissionless financial system, this alternative that is hopefully better than the traditional finance system. At the end of the day, people love to gamble, or essentially have the freedom to, I'm not going to equate gambling to trading, but, people want the freedom to just do what they want with their money. And in some cases, that means going 100x long on that Pepe token. In other cases, it's someone simply holding Bitcoin or Ether and keeping it really simple. Perps trading is wild on Ethereum L2s right now, because the trading experience, as long as someone can get past setting up a self-custody wallet, something like Frame, which is similar to MetaMask, or MetaMask itself being like a browser extension wallet, as long as they can get past that hurdle, as long as they can get to some sort of fiat on-ramp, because, I mean, really, no matter what we talk about, wanting to have unstoppable DeFi, like, at the end of the day, that there's normally a fiat on-ramp involved for most of us. Once you get past all of that, that trading experience on L2 now looks and feels so much like what you would have seen on, actually, I would say it's better than something like a BitMEX, something that you would have experienced on a Binance or Deribit, whatever.
Well,
so yeah, go ahead, Meltem.
If I can, sorry, before we go down the perps rabbit hole, so let's just have like a real talk moment. So if we look at what's happening right now, we're about to breach the debt ceiling here in the US. There's a great chart that shows the growth of government debt in the US over the last 20 years. It's not a good chart. The cost of servicing, right, at a 5% interest rate, the cost of servicing US debt is going to greatly exceed our ability to service that debt. Then you add in all of the unfunded liabilities in the form of Social Security, Medicare, Medicaid, et cetera. I think total underfunded and unfunded liabilities just on the government side, right, are many orders of magnitude larger than our ability to service those liabilities. And then you look at what's happening just with taxation. Taxes are continuing to rise. I used to live in New York. The New York State budget, right, is in a deficit. They have just in 1 year $5 billion deficit just in one budget, and that deficit continues to grow. What's the solution when you're a government? Well, you print more money. right? So that's number one. That's part of what has caused a rapid increase in inflation. So you print more money, it becomes more expensive to service your debt. How are you going to generate revenue to pay down that debt? Well, it's taxation. If we look at what happened in the last really big financial crisis, the Great Depression, what did the US government do? They seized gold. They made it illegal for people individual citizens to own gold. Why? Because gold operated outside of the banking system. And, what governments cannot control, they cannot tax, they cannot seize. And so here's where I'm going to sound a little like crazy and orange pilled, but I do think it's very important to think about the things you own. Like, I live in my house, I pay taxes for the privilege of living in my house. And obviously those taxes fund a lot of important things like infrastructure and schools and just the communities we live in. But I pay taxes for the privilege of living in my house. I pay taxes on the income that I earn. I pay taxes when I trade or participate in financial markets. I pay taxes when I buy a car. I pay taxes to drive that car. Taxation just continues to slowly chip away at everything. And that lever, right? The government only has a limited number of levers, and the biggest lever they have is taxation. So one thing I do think about and worry about is asset seizure. Also, our governments are not really held accountable anymore. There's just a massive lack of accountability, and I think this is not a U.S. specific challenge. I just think generally institutions, have themselves become ungoverned and unaccountable to the general public and to the constituents which they serve. So again, what I just think about is how important it is to have assets that cannot be easily seized or cannot be seized full stop, to have systems that sort of operate outside of the traditional infrastructure, that operate outside of institutional seizure, outside of government seizure. That is really important. I know it sounds a little crazy and doomery, but it is something to think about. And again, just a question that I ask myself is as I look at how I am allocated, as I look at, what I have exposure to, having an antidote to institutional chaos, to government chaos, having an antidote to this lack of accountability is a valuable thing to have. And so I just continue to believe that for that to exist and for that to continue to exist, it's very important that we participate in those systems long term, that we build those systems to be resilient, which again is, for me, LUSD kind of fits into that bucket. And so these are just important questions to ask ourselves, as the world becomes more chaotic, as markets go through this big transition and this evolution, there is going to be chaos. It's inevitable, right? If you think about thermodynamics, entropy is inherent to any system, and entropy is the degree of order or disorder in a system. And order and disorder, right, are two sides of the same coin. But as a system increases in complexity and in size, it tends to contain more entropy, right, or it tends to have increased entropy or increased chaos. And I just think our world is so complex. There is a lot of inherent chaos. Some of it can be controlled, some of it can't. So, if entropy is one of the laws of the universe, one of the fundamental mathematical truths of the universe, to me, things that are very simple systems, people love to criticize Bitcoin for its simplicity, but I think its simplicity is a great antidote to this inherent entropy that is present in all systems. Similarly, in DeFi, we have these really simplistic tools that at first glance are oh, this is so basic. There's no yield farming, there's no complex, It's well, maybe that simplicity, right, is a good thing. So I'll just add that in. We think of finance and crypto is sort of isolated from the laws of the universe, but our existence is governed by thermodynamics, and entropy is inherent to everything, including traditional systems, including these new systems we're building. And so reducing the surface area of complexity, reducing the potential for entropy is an important thing to think about. Just to bring it back to math. We love the math.
Yeah, and that brings me back, to the title, where is DeFi's time to shine? And for me, it's really what you outlined. For me, it's a hedge to the current financial system and the governance incompetence, as you mentioned it. And it's an A and a B. And for me, the takeaway is really you need to understand both. So I'm diving down, kind of, okay, how do these move, how does the dollars move to the system and where is the risk for me? But also understand what are alternatives I have in DeFi and which are really alternatives or an A, not just the B on DeFi and has the same risks or same intermediaries. I think that's really a key. And then for me, bringing it back to LUSD, making it really concrete. I then just realized when I looked, okay, what kind of alternatives I have to store value in USD? I saw, oh, okay, all this dollar is really controlled. So actually, if I hold LUSD, that's probably the only free dollar I have, which nobody controls. And I was kind of a bit baffled because every other dollar is controlled by an institution, by a government, and so on. And I think then if you go down to this rabbit hole, you really value kind of what DeFi enables you to have, that you say, hey, actually that's astonishing. It's maybe the soundest, most resilient dollar is, of course, if it's backed by the government, that's great, but they have also a lot of control. As Meltem said, they can seize it. So if that's something important, if I want to move it anytime, then I should really value these properties and opt for those. And maybe I say sometimes, yeah, it's I like the traditional system and it's just easier to bank with somebody, or if I need to pay taxes, that's okay too. But I think that's really for me the point. I think there with the cracks in the banking system, especially we in the West value much more what DeFi can do. But to really value that, you need to understand the differences and look really closely if DeFi really provides an alternative or if it's just kind of the same risk packaged in DeFi.
Yeah, which is not to say that the digitization and the API connectivity and the tooling enabled by DeFi isn't valuable, right? I think USDC is an incredibly valuable tool. I think it's really great for enterprises and payments companies to work with because it provides some of the fantastic benefits of what open money protocols can provide. And make some of these processes easier, simpler, can help reduce cost, and also can help make some of this infrastructure more interoperable. But at the end of the day, there are some of these fundamental differences. They're not going to be equally important to everyone, right? The utility of that uncensorable nature and that unstoppable sort of permissionless nature has different value to different people. But as an individual, like who cares about their sovereignty and their degrees of freedom, if you will, that can be really valuable asset. The last thing I'll just add is I think some of the things we're saying around asset seizure, et cetera, they sound really far-fetched, but just think about what you have come to accept as normal over the last 3 years and how quickly that has changed. I do think people don't realize how quickly the environment can change and how quickly humans can be conditioned to believe that what they're experiencing is quote unquote normal or quote unquote acceptable. And in fact, it's not. We have many less degrees of freedom in many ways than we had even 3 or 4 years ago. So I just want to highlight that even though some of these things around taxation, asset seizure sound far-fetched, it does not take very long in the internet age for them to become very normalized. And again, I do think that just given the speed at which ideas, memes, et cetera, proliferate on the internet, we're seeing behaviors and actions that would not be, normalized even a decade ago, being normalized in the span of months. And so I think it's very important that we live in a very different time where society's sort of view of what is and is not acceptable can change very rapidly, and that can be very easily manipulated. So I'm gonna put on my tinfoil hat for a moment. I'll be that person.
Yeah, I mean, Meltem, look at Credit Suisse in Switzerland. I think that's really shocking. I was really proud because we said, Switzerland never seized gold. That's a great property. But now seeing kind of just them overruling shareholders' right in that way, I think makes the point how quickly these things can go away and you can't take them for granted.
And nobody is talking about Credit Suisse. That's what's absolutely insane. Nobody's talking about it. Nobody's talking about Greensill. Nobody's talking about Wirecard. Nobody's talking about Credit Suisse. Like, these things quickly get swept under the rug. But it is absolutely monumental that a 150-year-old banking institution overnight just poof went away.
Yeah, that's one part, but the more shocking part is that the government steps in and says, hey, forget current law, shareholder law, it's an emergency, and these laws don't apply. And we just kind of force this sale, I mean, that's close to seizures or kind of these powers put to force. I think that's, for me, the shocking part. And everybody always said, oh, Switzerland is nice, kind of the legal rights, don't seize gold. But, the direction all these things are going, as you said, no accountability, how these things play out, I think it's quite shocking to me.
There is a great article that Arthur Hayes just wrote, and I think the TLDR on it was that it's more possible, more likely than ever, that you'll see more of a nationalized banking system in the U.S., or just it'll be to a greater degree more nationalized than it would have been in the past. And he says it much more eloquently than this, but it's something to the effect of, you don't want to be a part of the solution, which is socializing those losses with taxpayers and of course using inflation to solve all of it. And so to Michael and Meltem's points, I going back to like keeping it really simple, I think about, what do I hold in my portfolio that could not ultimately be seized? Something like a bank account that's really easy. Like overnight, I could wake up in the morning and have my bank account frozen. What am I totally in control of, to the point of, let's use self-custody wallets as like the standard here for being 100% in control. And how does the different investments I'm making factor into all of that? And I'm clearly like, I'm a little more extreme compared to, I think, the average person in society. I have a greater majority of my net wealth on chain, but for those that are just getting started and learning about DeFi, this to me, it gives you like an escape hatch, out of the system that really could change overnight, because lawmakers, regulators say the rules have changed because this thing that just happened would hurt too many people, or would at least hurt the people that we listen to. And so here's the solution, and you're going to all be impacted, or we're going to, again, socialize these losses. And this is the part of DeFi that we all love, is that, if in fact you are using, let's say, non-upgradable contracts like Liquity, for a fact, unless you like lose your seed phrase, you're going to be able to have a claim on those assets. And then also, I guess, just kind of leaving out the most obvious here, but I'm going to assume that anyone listening to this understands the greater degree of security that we inherit when we hold assets or transact on something like Ethereum or Bitcoin. I would caution anyone who is super excited about L2s. I'm invested in L2s. I absolutely believe they're the future, but they are all self-admittedly very centralized still. So if you've heard criticisms of a more centralized EVM-compatible L1, you should be equally concerned about L2s until they achieve this true degree of decentralization. Right now, it's a lot of promises and talking points, but it will come in the next few years, and it's going to take time. And there's a chance too now that maybe Bitcoin will actually see like a sort of mass adoption around its own L2s. I think that still remains to be seen, especially with everything going on with ordinals and all the excitement there that we've been observing. But anyways, yeah, appreciate you all having me. And I just got to say, I just really enjoyed, Meltem, everything you had to say. I feel like I was taking notes half the time. Less of a guest and more of a note taker today. But thanks for sharing all you did, and appreciate getting to talk with you too, Michael.
Yeah, thanks so much for having me, and thanks, DeFi Dad, for those kind words. I think again, my objective is always like we're all learning together. I don't think history repeats, but it certainly rhymes, which is an often used phrase. But I do think that's certainly true. And I think sometimes in crypto, we believe that everything we're doing is new, but it's not. There is nothing new under the sun, which is a great Bible quote, I believe, from Ecclesiastes for those who are so inclined. But I do think history has a lot to teach us, which is why I am an avid student of history, in particular of financial history. And then I do think understanding the fundamentals, at the end of the day, just as the universe has the laws of thermodynamics that govern the realm of the reality that we experience on a day-to-day basis. I also think finance has its own unbreakable laws, and those three unbreakable laws are the balance sheet, the income statement, and the cash flow statement. And so I think there are just fundamentals that we cannot escape. We have yet to build a perpetual motion machine. It does not exist. And I think often in DeFi, we are trying to create perpetual motion machines, and they're just fundamentally not sustainable. And so just remembering, the universe has certain laws that cannot be defied. Similarly, finance has laws over the long term that cannot be defied. And I don't think there is, an easy button, so to say. And so it's just important for everyone to keep that in mind. So I'm going to continue to try to educate, share what I know, and hopefully it's helpful to people as they're going through their journey in the weird and wonderful world of DeFi. That being said, if you enjoy, trading your meme coins with 100x leverage, go off, king or queen.
Thanks a lot, Meltem. Thanks, DeFi Dad, Meltem, Michael, all three of you for the spaces today. It is very insightful. As a reminder, one takeaway from my side as well is, opt for things without censorship, opt for hard, trustless assets like Bitcoin, Ethereum, and also LUSD. Do some due diligence on the different stablecoins you hold as well. Understand what is backing Frax, what is backing DAI, and all of that as well. And, just interesting, just one note I want to end on. Today's actually the exact day 1 year ago was the USD crash. So on your point, Meltem, history does rhyme, I guess. It's just interesting that our spaces was scheduled for the same day as that as well. This obviously is recorded, will be uploaded to YouTube as well. Thank you everyone for joining, and that's a wrap. Thanks everybody.
Thanks, Meltem, DeFi Dad, and Sam.
Yeah, thanks, Michael. Thanks, Liquity team. Ciao, everyone.